Good morning, good afternoon, good evening, everyone, wherever you are in the world. I'd like to thank you for attending Market Directions interviews. Today we have Kiana Danial, very well-known Forex and investment advisor and also educator. Ms. Danial, thank you very much for coming.
Thank you so much for having me.
You know, your personal history is one of the more interesting that I've ever come across in the finance industry. Your trajectory, and one has to call it a trajectory since it's been straight up, from Persia through Japan to the United States, is something that I think would interest most people as to how you decided to get involved in finance and foreign exchange. Could you expound a little bit about how you decided to make that decision after you came here?
Right, absolutely. Well, I mean, the reason why I came here was because I wanted to work in the financial industry. When I was born and raised, as you said, in Persia, aka Iran, in a Jewish family, and I went to Japan to study electrical engineering, which is very popular among Persians to become engineers. Engineering is actually a status, by the way. In Iran, it's like a doctor, so we'll call you Engineer Daniel. So they don't give that kind of benefit to Americans, unfortunately, or in English. So I studied electrical engineering in Japan for 6 years, and I had no idea about finance or financial markets at all. And my professor was actually very anti anything to do with finance because he was a scientist and he believed money is bad and you shouldn't, as a scientist, even care about money. And I never even thought about going into finance, which is a very interesting mindset that I actually talk about. That was a very, very bad mindset. But in 2008, when the market started to crash, I was still a university student, and all I could hear was that the US dollar value, yes. And I had accumulated, well, a bunch of Japanese yen in my bank account because, well, I had a scholarship, I had a TV show over there. And I was hearing that the US dollar is going lower, and all I could think was maybe I should, because my family lived in the US, right? I thought maybe I should start buying US dollar now that is becoming cheaper compared to the Japanese yen. And it was in August 2008, and every day I would go to the ATM, and in Japan you can actually exchange in the ATM in your bank account. So I would go to the ATM, I would exchange just a little bit of my money, the next day it would go lower. And I was like, damn, I should have waited yesterday. I shouldn't have exchanged yesterday because it's going down. And I could hear more and more that it's probably going to go lower and lower and lower. And I was just talking about this to one of my friends. I wish I could just write a code if it's going to reach, like, let's say 93. I wish I could write a code so that I could order my bank to buy it when it reaches 93, so I don't have to go to the bank every day. And she told me, oh, the coding, this industry is already invented. You're not inventing anything new. It's called Forex trading. So why don't I help you with that? And so she helped me create my first account with Hirose FX in Japan. And I did my first trade. I put in $10,000 until September 2008. I doubled my money in a one single dollar yen trade, 14-time leverage. It was awesome. And everybody else was panicking. I was like, hey, I made money. And that was my first really interest in the financial markets. And at that time, I was a little bit disappointed in the engineering industry. I was the only girl in my class for 6 years, and it wasn't fun at all. And I was thinking of changing, and this really gave me the trigger. And for that reason, I did some sort of a research. I came to New York once. I fell in love with it, and I decided to move here so that I can work on Wall Street. And I moved here 2010. Within 2 weeks, I was working on Wall Street in the FX industry.
Did you find your background in mathematical applications and engineering and understanding of algorithms and all those things of use? And is that the most important thing when you educate and when you teach people, because it's one of the things you do and everyone knows you for this? Do you find that the technical aspect, either algorithms or technical trading, or the money management aspect is more useful? And which do you try to teach?
I teach money management now more often and risk management. My engineering background, I don't know if it's of any benefit because I honestly can't compare myself to being an engineer or not being an engineer. I really doubt it, because trading, if you get a handle of it, it can be, it's a little bit different. It's not, the math is different. I don't think, maybe my analytical skills does come from my engineering background, because I am very good with the charts. But
Well, everyone uses those.
excuse me?
Everyone uses charts as the entry point. The problem is that as traders, the difficulty is deciding more than anything else. You know, the old cliche from the markets: when you learn how to lose money, then you'll know how to make money. Which seems totally counterintuitive, but it's not.
So that is exactly what I noticed when I started teaching FX, and my students would come to me, and I really realized that a lot of them really don't know where they're going, what their plan is, what they want to make, and what their risk tolerance is. And that was a very key point to me. And that is the reason why I actually started educating myself to become a financial planner, so that I can help my students more. And the exit, and your point is absolutely correct. Entering the market is easy. Exiting the market is when it's that is what makes all the difference. And for me, it is not a one-size-fits-all at all. Your trading strategy is not going to be similar to mine, because I am in a different financial situation. I have different risk tolerance. By risk tolerance, I don't mean my willingness to take risk, it's my ability to take risk. What is do I have any debt? Do I have an emergency fund? Do I have a lump sum financial goal coming up? Do I need to buy a house? Do I have children? All these things really are different, and traders have to understand that for their exit strategy, they really have to create an exit strategy, and also a portfolio diversified to meet their financial goals. And that is exactly what I'm doing right now. We basically help students to create a financial plan for themselves, and that comes with basic financial analysis, the ratio analysis. You compare your ratio to a benchmark.
Absolutely.
And then we've developed a questionnaire that helps you calculate your risk tolerance, which is a combination of your willingness plus your ability to take risk. And based on that, you're going to create a portfolio, which is not necessarily Forex, because some of my students actually, I don't recommend for them to trade Forex, because that is a different level of risk. So their portfolio needs to be a little bit more diversified and contain a little bit more low risk assets.
When you advise people, do you advise them into Forex sometimes? Because I remember when I started trading on, a few years ago on the bank desk, there was no advice. Traders are in general, and you're in a complete exception to this, are generally inarticulate lot. They're not particularly good at explaining how it is they handle their own risk analysis. And one of the hardest things for me to learn when I started trading was, how do you approach this? The other traders gave me no advice. They would give me a couple of cliches, have a view. Okay, I have no idea what that meant. Out the window, what kind of view do they mean? But I eventually learned, because I was in a pressure cooker. When you deal with people who come to you and say, I need some advice on this, how do we go about doing this? Where do you start with this information?
Right, so that is absolutely correct. You can't just have a plan and then not know how to apply it, right? So the system that I developed actually for Forex traders is, well, my latest book is Ichimoku Secrets. And it's Ichimoku combined with Fibonacci. I use Ichimoku as an indicator to get in the market, and I use Fibonacci as an indication to get out. And both Ichimoku and Fibonacci provide me with 3 levels of risk, basically. So if you are a low risk investor or a trader, you're going to use a specific Ichimoku indication, which is designed for lower risk.
Right.
And you're going to combine that to exit at a Fibonacci level that is also in accordance with your risk tolerance. So that is basically what, based on my years and years and years of observing the markets and seeing my students, that is, I don't want to say that I came up with it, but that made the most sense to me to create an investment strategy based on the technical analysis more so than the macro, so that you have your entry and limit, profit take and limit orders already in place, no matter which direction, no matter what's going to happen in the markets, and especially in this environment that really nobody knows what's going to happen next.
I'm going to ask you about that in a minute.
Yes. So with that, I'm actually relying a lot more on the risk management based on the technical analysis, which is the Fibonacci Ichimoku combo, than trying to follow a president's Twitter account every 2 seconds, or trying to.
You know, it's interesting. I'm a much slower learner than you are. And after about a decade in foreign exchange, I finally came around to the idea that one of the things that's difficult to convey is that you actually, as a trader making decisions, have very, very apt insight into the market. Because when we write about the market, I know I do it, I use it as a short, and everybody does, we always refer to the market as if it is some entity sitting underneath Wall Street, making decisions, crunching bones, and we have to figure out what it is. Sorry, my kids are reading Harry Potter, so I've got all these images around. It's Harry Potter all the time in my house. But that's not the case. The market is an amalgam of all of our decisions. So in a way, the market, our own decisions, are an insight into this. One of the things the market also does, and I'm not going to preach on this, one of the things the market always does is look to take profits. And so I came around to exactly your consideration that the Fibonacci's are what people use. Why? Because the people who are in the market need to take profit. That I thought was a useful insight, though it took me a decade to get to it.
That was actually, it took me a while to get there as well. And what I actually read this from, I think it was Tony Robinson, a completely different category and different industry, but he was saying, don't try to be a pioneer, because pioneers are the ones with arrows on their back.
Deadly, absolutely.
I've stopped trying to outsmart the market. I move with the market, and I know everybody uses Fibonacci. Everybody looks at the same exact level. So why go against it? Just follow the market, follow the sentiment, and everybody will together will get somewhere.
You does have someone. I mean, one of the cliches I remember from is never turn a day position into a strategic position. It goes against you in the daytime. You decided, well, okay, this level didn't really work. I'm not where I want to be, but tomorrow is going to be a better day. One of the great seductions of trading is to put hope into every trade, and that requires a great deal of discipline to keep that at bay.
Absolutely. So I've given up on day trading. I don't day trade anymore.
Nor do
because
I.
of that. Because it really is hard to control your emotions. For example, if I'm not in a trade, I give the best advice to my students. But when I'm actually,
I know that very well.
Then you're hoping that the market is going to go that way. So you look for anything to justify your hope. And that is really, really something that sometimes I'm like, maybe I should just stop trading so I can get better advice, which is interesting because people think people who trade are gonna give the best advice, and sometimes like, no, when I trade, I become emotional.
It's difficult. I agree. I mean, another thing, you know, that's because in foreign exchange, everybody starts with a demo account, and suddenly they're reasonably good traders because they have made money in a demo account. I mean, we're a retail company here, so this is something we understand very well. And I would always tell people that it's not the same. The emotional involvement, you know, it's that old line from Robert Pirsig's book, Zen and the Art of Motorcycle Maintenance. The motorcycle that you were working on is a motorcycle called yourself. And this gets kind of nebulous in education, but I think you do it very well to emphasize what it is that people need to pay attention to. And it's generally not Fibonacci's. No, I mean, it is as far as the point goes, but the real controller is you.
It's you. And that is the reason why I even try to not look at my account as often. I create my strategy, put my entry, put my exit order, and I let it go.
Right, exactly.
I let it go and I let the markets move. And that is why I agree with you that you don't want to turn a day trade into a long-term trade. But in my experience, at least with the Forex market, the markets really just move in cycles. Eventually, everything is going to go back. So if you stay in the market long enough, you are going to make money. And in the past year, I've actually stopped using stop losses. I use a lot lower leverage, so I'm not going to max out. I do not trade with the money that I can't afford to. I don't borrow money from a broker, so I don't worry if the market's completely in my different. Right, absolutely. So I've stopped using stop losses, and I have started that when the market starts going against me, I have started to add on to my position. I do the pyramid, and I just wait it out. And that has become my sole strategy in the past year, and has turned out it's a lot less stressful. I don't get emotional over it, and I just let the markets move. And my Forex account is only 20% of my account, and I'm not relying it for daily income. So that has been my trick, because I have seen that when people really want to have consistent revenue, monthly revenue off Forex, it becomes incredibly emotional. But if you just let it go, eventually you are going to make that money. So I really have been encouraging my students to treat Forex also as an investment. Also, it is, even though it's kind of interest with people like it's not an investment, what are you investing in? It's just money exchange. But I believe that you really have to treat it as an investment. And for example, for stocks, a short-term investment in stock market is at least 1 year, right? I mean, I'm not talking about day traders. With Forex, I don't believe it should be any different, right? Because the markets do go back up, and that's the beauty of it, because the markets normally move in cycles. So
as long as you're trading, as you say, as long as you're trading your risk capital, this is not the type of market, or trading in general is not the type, and I know we're talking a lot about sort of the psychology of this, but I've always thought that that's the most difficult thing for traders, including advanced traders, to learn how to control. But the cycles in foreign exchange are only cycles that you can take advantage of course, when you are trading at a low leverage, as you say, with risk capital. One does not and should not attempt to produce money for the grocery bills or whatever other bills you're paying for, the car payments, for and from foreign exchange trading, or really any other kind of trading.
Right, absolutely, 100%. I mean, if you want revenue, then you should probably just go start investing in stocks that pay dividends. Like, that's the only way that if you want to create revenue, right? And yeah, so that is how my trading has been evolved. Because when I was reporting back in New York Stock Exchange, I was very involved in the markets. I was always talking to CNBC is just located on the floor, and we were talking to the reporters. I was very involved with the market noise, and that really made me an emotional trader, and I blew up my account. And I refrain from going back to that situation, that I follow everything with the markets. I don't even have CNBC on, or even Bloomberg. I just read the news every morning. I'm like, all right, whatever, markets are going to go nuts about something, but I'm just going to wait it out. I'm going to make my decision after the markets have calmed down.
You know, talking about that, this is kind of a difficult or an interesting. It's that old, that old phrase, which is supposed to be a Chinese curse, which is not. May you live in interesting times. It was not written by. It was written by some Western translator of Chinese stuff, but as people have said, it's now Chinese. The current market situation is one that I've been writing about, and you've been writing about for a number of years now. The disconnect, especially in the equities, the disconnect between the actual performance of the economy and the level of equities is something that is difficult in a way to explain to people not involved in the markets. How do you handle that when your students want to know, well, the market's way here, is it going to go higher? What is the level, or what is the logic that you use to convey what's going on in the markets?
As you said, I 100% agree that at least in the past few months, the market has been taking cues from the political developments more so than the economic developments, and it has been very hard to keep up. And I do get questions all the time. Oh, why did the dollar drop? The Fed just raised the interest rate. What, like, everything is going against. So the only logic behind it for me is market sentiment and the fact that, for example, in case of the US dollar, for example, we all know that the rate hike was already very, very highly priced in the US dollar. And after that, well, because the Fed didn't change their economic outlook, it kind of disappointed the market, so they stopped buying. They just took profit. And it wasn't only just taking profit, but I think also the fact that they didn't expand and have a better upbeat economic projection than last time, it kind of disappointed them. But that is, it is very, the macro is becoming increasingly more and more difficult to keep up with.
Let me ask you just a standard economic question. The Fed policy, and I know this is a little bit out of the park, but I'm always interested in this question. The policy the Fed's been following for the past, well, 8 years basically, is defensible mostly by the negative. Well, things would have been worse had we not done this. Do you think that is an accurate assessment of what the Fed has done? Because it seems to have provided us with a joyous market, but very little joy anywhere else. This is my own interpretation of it, of course.
That's an interesting, I never thought of it that way, actually, but that's a very interesting interpretation. The Fed, well, you mean like Janet Yellen, though, in the past month, well, few months, she was a little bit more upbeat. Are you talking about? Right. So they definitely, I wasn't trading before that, so I don't know about how the markets used to be, the Fed, so I'm relative. I've been trading only for
the early 90s. You'll have to forget.
So I don't remember that. I don't have any information on that, but this is the only market that I know. And I always know that I've come to understand that, all right, whatever the Fed says, people are going to price it in. And then whatever they do, the market is just going to, for me, it has been buy the rumor, sell the news. It's just simply the case.
And it has been again on the dollar now, as you just said. We just saw the Fed actually do what they said they were going to do the first time in 3 years since they started raising rates. They actually raised their rates. It looks like they're going to do 2 more times. The economy is growing somewhere around 1.5%. And the dollar is paying more attention, if you want to make a macro link, to what the economy is doing than what the Fed is doing. At least
absolutely. Yep.
Which again is something which makes it difficult for beginning traders to comprehend what's going on.
Right. It is not definitely as easy as just going on FX Street calendar and saying, okay, the Fed did this, so let's do that. It's definitely not as easy as that anymore, for sure.
No, it's not. It's not. One other thing that I'd like to cover is the way that you approach the integration of all the markets. Because you say that, and I agree with you, that diversification, this has long been a policy or a principle of investing of all types. That diversification, if it doesn't protect you from everything, it mitigates things, which is useful. How do you fit Forex into that particular schema of the way you're looking at markets?
Are you talking about how to come up with investing strategies based on looking at, say, what the US dollar is doing? Or are you talking about my portfolio diversification and how I allocate?
The portfolio diversification and how you fit the actual trading aspect of it into it. I know you treat foreign exchange as an investment, and I agree with that, but still it's a little different than, and it requires a little more attention than investing in stocks or bonds or things like that.
Right. So the way that I have allocated it, and I encourage my students to do so as well, is that you first want to calculate your risk tolerance. If you have an aggressive risk tolerance and appetite, then you can add 20% of your portfolio. You can have a 20% Forex allocation. And I normally don't have that in the same portfolio that I'm investing in my other assets. Right. So it's a different 100%. Stock market definitely needs less attention than Forex. I check my Forex account at least once a week just to make sure everything's on track. With stocks, it's once a month when I do the moderations. And so it also comes down to level of, well, love for Forex. Forex can be very lovable and addictive.
It can be exciting.
And very exciting. And I'm guilty as charged as well. I love just following the markets, because it is easier, it is more fun to look at. There are only a number of currency pairs that you can follow to begin with. And it is still kind of easier to comprehend, but it's still more volatile. It's completely, I agree with you. It's a different monster. So I only recommend Forex to investors who, first of all, like Forex, because you gotta like it. Otherwise, it is really not. At the end of the day, I don't think Forex is for people who really are looking to, as I said, generate income, or if they don't like it, if they don't love it, then they probably shouldn't add it to the.
That is a very good analysis of the way that I think probably professional traders as well approach the market. We've reached the end of our 30 minutes. Kiana, I thank you very much for attending and giving everyone online and around the world the benefit of your advice. And I hope you'll come back. And I thank you very much.
Thank you so much for having me. Have a nice day.
Take care. Nice to see you again.
Likewise.